And I think I'm going to finish after this. This will be all the videos I'm doing today. Um, couple, there's really a couple of different articles I'm putting together on Zero Hedge. There's one big problem with the Trump budget, and Goldman Sachs Vampire Squid has a message. We have entered the slowdown phase, but stocks don't seem to care. So let's take a look at the budget problem with one big problem with the Trump budget. On Tuesday, the White House revealed its proposed 2018 budget, which, as discussed earlier, anticipates some draconian cuts to government spending amounting to a massive $3.6 trillion over the next 10 years, broken down by department. This is who wins and who loses. The following are going to be positive numbers, okay? Department of Homeland Security, up 7%. VA, 6%. Defense, 5%. The rest of these are negative numbers. DOJ, 4%. Energy, 6%. INT, which I'm assuming is Intel or intelligence agencies generally, I guess, 11%. HUD, affordable housing. Oh, Trump, I love you. Riff-raff will soon be gone. Riff-raff will soon be gone. HUD down 13%. We're going to take away from that. Transportation, 13%. Ed, which I'm assuming is education, 14%. HHS, again, healthcare stuff, 16%. Labor, Department of Labor, 20%. Agriculture, 21%. State Department, 29%. And EPA, yes, 31%. But anyways, while one can debate the merits, philosophy, and ethics of the proposed cuts, there is another, potentially more concerning observation to emerge from the budget, or rather its assumptions. As a reminder, as of May, the current expansion, which started in June 2009 and which has lasted for 95 months, is already the third longest in U.S. history. So what emerges when looking at the underlying assumptions of the Trump budget? Nothing short of assumed economic nirvana. I'm not talking about the old grunge band, I deny you, because someone's in denial, in denial. As the following table, taken from page 45 of the budget titled A New Foundation for American Greatness, shows the U.S. is expected, and you know how I'm always rolling out here, something bad happened unexpectedly today. The markets are unexpectedly, So again, the U.S. is expected to grow at 2.3% in 2017 GDP, 2.3% in 2018, and so on, until GDP plateaus at around 3% in the year 2020, and remains there until the end of calendar year 2027. You think that's going to be possible? All those straight years? What this means is that the White House is assuming, again, expected, that there will be no deficit for the entire duration of the projected 10-year period. But that's not all. Wait, there's more. Because it also means that the White House budget is based on the assumption that the expansion that started in June 2009 will last at least until December 2027, or an absolutely unprecedented 222 consecutive months of expansion. There is a problem with that. As the chart below shows, which I don't have to show you, an expansion of that duration, nearly 19 years in a row, would not only be the single longest expansion in U.S. history, but it would also last double the next longest duration ever recorded in the U.S., the expansion which began in March 1991 and ended with the dot-com crash in March of 2001. So 10 years is about as good as it gets. But let's see, hold on. Because first of all, this one didn't start, we're talking about starting in 2017. 2017 to 2027 is 10 years. This expansion started in 2009. So in other words, fat chance, not happening. Unfortunately for the White House, while we are impressed with such grotesque GDP goal seeking, we have a feeling that the next recession will come far sooner than the budget projects. On to vampire squid, also known as Goldman Sachs. We have entered the slowdown phase, but stocks don't seem to care. Under normal circumstances, we would say it is strange, if ironic, that the same day the S&P is trading just shy of an all-time high 2,400 again, Goldman comes out with a note warning that global growth momentum appears to be slowing. The ISM has likely peaked, and the U.S. labor market has tightened further. We appear to be in the slowdown phase. It goes without saying that circumstances are anything but normal, and that if the U.S. economy is in a slowdown phase after a quarter in which GDP rose 0.7%, we would hate to see what an all-out contraction would look like. And again, they're saying we should see 2.7 GDP this year percent. It's at 0.7 starting this year so far. Whoa. Sarcasm aside, echoing some of the confusion voiced by Bank of America earlier today, Goldman notes that so far equities and credit are holding up well relative to historical slowdown phases, while other assets, U.S. dollar, commodities, and treasuries, are underperforming relative to history. Well, guess what, Goldman? Cryptocurrencies are shooting to the moon right now. And that's not a market you guys control, or the governments, or the treasury, etc., banksters. They're doing phenomenally well. So, why the disconnect? Goldman suggests that even though the economy has peaked, historically, slowdowns have not necessarily been bad for risky assets unless a recession results. Wait, isn't that what markets do? They discount the future? The answer here, obviously, is not under central planning when the market's only reaction function to any move lower is to buy the dip. See Bank of America. These markets are a very weird link. However, it would not be politically correct for Goldman to admit that the market's primary function, anticipating in reaction to the future, no longer works. So it provides some other ideas, claiming that some asset prices, primarily the Treasury term structure and U.S. HY spreads, tend to reflect recession risk early, while equity momentum tends to fade. The ISM and the unemployment rate also appear to give some advance warning. But wait a minute, aren't those rigged numbers anyways? So your warning would never go off, right? But first things first, why has Goldman, which traditionally was the biggest economic cheerleader, thrown in the towel? The answer? In our view, the U.S. is in the late cycle. While U.S. growth remains above trend, U.S. growth remains above trend? What trend? 0.7% GDP. What trend what are you talking about? Anyways, while U.S. growth remains above trend, we think growth momentum has likely peaked, and the U.S. is at or near full employment. Not a chance in hell of that either. The ISM Manufacturing Index recently decelerated from 57.7 in February to 54.8 in April, and we think we are in the slowdown phase of the ISM cycle. In our previous two goal reports, we showed that as the level of the ISM slows down from a peak, on average, equity returns fall and equity volatility begins to pick up. However, we also argued that these shifts can take time. Our U.S. economist model of recession risk suggests that, although U.S. recession risk is rising over the next 9 quarters, it is still near the unconditional historical average, which suggests a more muted risk asset slowdown in the near to midterm as opposed to a sharp contraction. All else equal, when even the company which runs the White House warns that growth has peaked in a sub 1% GDP quarter, perhaps it is time to get nervous. Perhaps it is, but not for stocks, because as Goldman notes further down in its analysis, this time equities have outperformed their history while other assets have lagged. No. Goldman, again, you must not be looking at cryptocurrencies right now. There's nothing on the face of the earth that has performed like the cryptos. Let me say that again. Nothing on the face of the earth has performed like the cryptocurrencies. Now, I shall continue. We think this is largely because of positive growth data, favorable positioning in a good quarter one earnings season, and also because expensive valuations in government bonds make them an unattractive alternative. In addition, strong policy expectations that had been in place have largely retreated, resulting in less upward pressure on inflation, yields, and the dollar in our view. Less coupon income this time, relative to history, has also been a headwind to government bond returns, with yields almost half what they have been on average in slowdown phases since 1990, 4.1%. We have negative return expectations for duration from here. Anyways, I'm kind of done. Let me just finish this off. There's a bit more to this article, but I think the point's made. Maybe stocks are right. Maybe this time it's different. The business cycle is dead, and there really won't be a recession for years and years, if ever. All of the above, of course, ignores the real reason why stocks refuse to drop. The Fed and Trump puts discussed by Bank of America earlier, according to which U.S. equity sell-offs have seemingly become embraced as alpha, i.e. buy the dip, opportunities instead of being feared as bona fide risk-off events, as the central bank put has become a self-fulfilling prophecy. What's the point of selling if other ETFs, algorithms, and quants will simply use that as a catalyst to buy, ignoring any and all economic data? Lastly, with the Fed eager to step in with its hints of more QE or rate cuts, the second there is even a modest sell-off, it is difficult to see what, if anything, except the Chinese crash, of course, can end this arrangement. So, yeah, anyways, and to add a little more fuel to the fire, I was going to do a video completely on it, but I do have it in my email, okay? And I think I'm going to go ahead and cover it right now because I don't want to do a full video on this one. I just don't. We saw the House vote on Obamacare repeal and replace. That was a while ago now. What the hell happened? Senate, where are you guys at? What's going on? What happened? Well, again, zero hedge. I can scroll back up. Trump saves Obamacare again, for now. The Trump administration and the House have officially asked for another 3 months. We need another 90 days. Can you give us 90 days to work out a lawsuit over subsidies that help poorer people afford to use their Obamacare insurance plan, further delaying a long-running legal fight that's already destabilizing the health law? As Axio notes, the key point is the parties continue to discuss measures that would obviate the need for judicial determination of this appeal, including potential legislative action. Without the payments, insurers have threatened to drop out of Obamacare or substantially raise premiums, and customers could face thousands of dollars in, quote-unquote, my favorite word, unexpected costs. The Trump administration could still choose to drop the appeal, though other parties are attempting to take up defense of the payments. Staff officials, the insurance industry, and Democrats in Congress have pushed for the payments to continue, saying that ending them would upend the insurance market and cost millions of people their health insurance. Right, so the insurance companies need some kind of health subsidy too. On top of the outrageous fees we're paying now, and every year that goes by, I keep hearing 20% increase, 30%, 40%. Why is my premium going up if everybody and their mother's being subsidized, including the insurance companies? And they're saying, we have to get this extra money, or we're going to have to get it from somewhere. You know who? The sick. And as I said before, the numbers show that 5% of the population who are the most sick cost us the most money all of us have to pitch in. We are making 44% higher payments than we should regarding health insurance because of the 5% of grossly sick people in this country. 95% are paying 44% higher premiums and whatnot because 5% are really sick, and they cost a lot of money. In big pharma, in big hospital, and big everything and scam this and scam Medicaid. Everybody's got to get their money. I need my money. Give me my money. And when you threaten to take it away, lawsuit, I'm filing. That's the American way. Sue them. File a lawsuit, sue them. The American way, isn't it? Unbelievable. I never thought I'd be, talking about this kind of stuff as a young man, back in my heyday. Politics, get out of my face. Government, finance, shut up. You're freaking stupid. How freaking stupid. Who cares about that crap? Talk radio, listen. Turn the freaking radio on. I want to hear music. Nope. Not anymore. Not anymore. Those days, years ago, long gone. I can't help but to look at this stuff now. I never thought I'd be around here looking at how an actual banana republic functions that's supposed to be, at least by its definition, as the greatest nation on the face of the earth. And it reminds me of these laws they try to pass. The Help the Senior Healthcare Act of 2016. And then you look at it, there's nothing in there about helping senior citizens. It's going to charge the crap out of them more. Something like that. But they give it this wonderful name. Help the Senior Citizen Healthcare Act of 2016. We must pass this bill, this legislation. We've got to do it. As Nancy Pelosi said, let's do it for Teddy. Do it for Teddy. Teddy Ruxpin? Or Teddy, the creep Teddy, the congressman who died. Oh, that guy. Yeah, I feel real bad about that. Not. Anyways, this is called a shit show, a banana republic, opposite day, perhaps, when you're a kid. Today's opposite day. Greatest nation on the face of the earth, opposite day. Here's some real data. Ooh, yeah, that is opposite day. Opposite century, perhaps. So, gots to run. Take care.